I think a founder who's happy with a 1-2 page term sheet which doesn't list out the rights is making a mistake. They don't know what they're going to sign up for.
So I've actually had founders who I've sent the term sheet and they've literally signed it in 2 hours and sent it back to me. And I've picked up the phone and said, did you speak to a lawyer?
See, the more governance issues come up, people are adding more stringent clauses and rights that you're looking to enforce when it's already too late.
Founder majority on the board. We've been in multiple situations. I think founders are enamored by stories of Facebook and Google of these super voting shares. In India, we've seen founders say, hey, but why should founders not have control of the board?
This is not the old India where you take all the debt from the banks and convert it into your personal equity in London and run away with it. Right?
AI has told one of our founders that if it's without cause, accelerated vesting, that's the right path because you're letting this founder go. That's not what is reflective of where we are.
People think of AI wrong, and I think it applies in law firms as well. Instead of making humans less relevant, it makes humans relevant only to things they should be relevant for.
Our job as investors is we are not here to screw you over. We are here to protect the company when shit hits the fan.
On the one extreme is the 20-page term sheet, which is trying to be a SHA.
Too cute, yeah.
On the other extreme is the 1-pager, 2-pager customary rights. Both are wrong.
Yeah.
Market is somewhere in the middle.
Welcome to the Zero to Infinity podcast. We have a very special episode today. Over the years, we've spoken a lot about term sheets, which terms matter, why should you care. There's a bunch of episodes we've done, which I'm sure we'll link in this podcast. I'm going to start by introducing our special guest today. So we have Archana Rajaram from River Law, earlier Rajaram Legal. Archana and us go back, I think, 10 plus years now. Archana has been part of some of the most prominent venture deals in the ecosystem. And has also worked very closely with Z47 as an outhouse counsel of sorts. We have Avnish Bajaj, founder and investor at Z47. So before we dive in, I'm going to start by actually just tracing the evolution and quick sort of rewind of everything we've already spoken. We had a episode called the terms of term sheets. We also had a episode called difficult terms in term sheet. Now actually doing a fast forward to 2025 and with all the context of the last few years and what we've seen play out in the ecosystem, we've had the bubble of 2021 where term sheets were getting signed in hours and sometimes money was getting wired even before term sheets were signed, all the way to multiple IPOs and multiple companies that have listed. Where are we today in the ecosystem and how have you seen term sheets evolve at the early stage growth and then pre-IPO? And what have been some of the learnings the last few years?
It started off with fairly detailed terms, but I would say founders didn't pay too much attention because singular focus was getting cash in bank. And most of those clauses look like something that'll come up 7 to 8 years later or 6 years later when the company scales, is looking at an exit. So they thought it's a tomorrow problem. This valuation checks the box. So let's figure it out. And it sounds so legal. They don't have the time to even find counsel when the term sheet is in. So then you hunt for counsel when the def docs are in. And then it looked overwhelming. There's 100 pages. And how do you map what was there in the term sheet? Then it's taking a lot longer to do. Then there's the approach of, do you keep a simple 2-pager or do you be transparent and share like a 10-pager that gives you some idea of it? But with all things considered, that 10-pager term sheet really doesn't achieve anything because it gives you some sense of what's coming up, but the devil is in the details. So the SHA, when you have all points up for discussion, how do you have the exceptions? How do you make it more reasonable? How do you reach that middle ground? You don't have a month during the term sheet. You should not be spending more than a few days to lock that term sheet in high level points. And then you'll say all of this will be customary or you will have reasonable protections in the def doc. So where we are today, we usually see 1-pager term sheets across stages. Because if someone's coming in at a Series D, at a growth stage, there's an existing SHA, there are multiple investors. So you can't really drastically move away from that. You do need to go by the existing SHA, but you don't have the time to read it as well. So you'll have some language saying certain things will be in line with the existing SHA, and then few things like your follow-away thresholds, few things will be based when the full round construct is stitched together. So 2-pager term sheet across stages is what tends to win, if not 1 page.
So I know in the last episode, you had actually said that as a founder and as an investor, your preference is to have all the risk taken out upfront and to actually have a more detailed term sheet so that there's no negative surprise for either side. in the future. How do you kind of make sense of where we are today? Because we've now seen term sheets in some cases where our companies receive, we've invested early and there's a follow-on investor coming, and it just simply says, here's the valuation, here's the check size, and customary rights, and literally lists the terms, and it's a one-page term sheet.
Yeah.
Is that a good thing, both for the founder and for the investor?
So I am still of the view that all the key terms should be there. But if somebody is sending a term sheet like that, I tell the founder, send them the current SHA, mark up the term sheet, and write there customary rights as per existing SHA. Then you're taking the risk out of it. Then you force them to read the SHA, and then you won't have surprises later. So I believe that there's a lot of bait and switch that used to happen. There's been a lot of evolution. Let me ask you, actually, TD back. We are founders first. We trust founders. Why even bother with all this stuff? Like so many terms and term sheets, and we have discussed in other places, you don't really make money on terms. So why bother?
I had read this phrase and it stuck with me, which is weak fences make bad neighbors. And I think that's the reason why you need to actually have a clear understanding between the founder and the investor of what is each side signing up for, so that there's no confusion in the future. There's no misaligned expectations of, hey, but I thought when you said founders first, basically you don't need anything. Or when you say you're founder friendly, these are the terms I will get. So I just think it's important. It's setting up the company right from a governance perspective. As an investor that is coming onto the cap table, I have significantly lesser information compared to the founder who's been running the company. So there is a massive asymmetry of information. In the case of, as obviously companies grow, as our association with the company has been there for a longer time, we do, and we are happy to actually relax some of the requirements.
And I think that's the point, right? Founders first doesn't mean firm last. But to your point, I actually really like that phrase. For me, the connect with the founder gets us to the term sheet stage. But because of asymmetry of information, there are still rules of engagement to be spelled out. And I think it's great for both sides. I think a founder who's happy with a 1-2 page term sheet, which doesn't list out the rights, is making a mistake. They don't know what they are going to sign up for. Now, what has changed in the last 5-7 years since we last did this episode? Exits have happened. IPOs have happened. Write-offs have happened. Anti-dilution has kicked in. So, if you remember, we used to all discuss sometimes about our peers or somebody else saying they don't know what they are doing because this, or our US counterparts would tell us. Then we would go back and we would tell them, but our other peer set doesn't care. They're like, they don't know. This all breaks at exit. And I think a lot of that has played out. Going back to Archana's background, since you gave the very formal official one, we also take rejection well, by the way. So the way this relationship started was with rejection. We wanted her to be our general counsel. And then she came and she said, I want to be an entrepreneur. And we are truly founders first. I don't think one person who has told me I want to be a founder, I have tried to change their mind.
Yeah, absolutely.
Right? Yeah. And it worked out great. The anchor client.
It worked out very well for you.
Yeah.
But one of the things in our own evolution of this journey, we all three of us, we used to go with very detailed and we used to look at our interests quite a bit. Founders' interest also balanced the interest, but there was a third missing piece that I remember coming into our lexicon maybe 2-3 years into it, which was what is the market. And the reality is, this is buying and selling business. It's a capitalism. You have to play by market.
Yeah.
How is that? The market has evolved, right?
It's also, it looks transparent and it's fair. The founders see valuation, but then here he has full visibility, right? But it's actually unfair to a founder because you can ask for your requirements. You can offer some concessions, but everything, then a founder is sort of signing up to it and there's no room to negotiate in the definitive. So you say indemnities. Indemnities is a 3-page construct in the SSA. What are the limitations? What are the protections, the sunsets, time caps? You can't plug that in a term sheet. So what do you achieve with that? Even something like consent items, right? It's great. You give them a list of 10, 15 things you want to say, key employees. But what is the key employee? Is it 1 crore? Is it CXO? Is it 2% ESOP? So because a founder doesn't have the ability, doesn't have counsel, or even if you have counsel, then you're negotiating a full-fledged agreement in the term sheet. So it was more that you're putting all this out there, but no luxury to make it a reasonable measure.
So I think that's where the convergence happens.
Right.
On the one extreme is the 20-page term sheet, which is trying to be a SHA,
Too
SSA.
cute, yeah.
On the other extreme is the 1-pager, 2-pager customary rights. Both are wrong.
Yeah.
Market is somewhere in the middle.
Yeah.
And the market, therefore, is all the relevant terms should be there. If an agreement were to come saying just customary, I would bet you we will tell them to go and we will say, here's the SHA. Customary, there's no customary. Either it is our customs, which is our SHA,
Right.
or it is market.
Actually, I want to pick up on a point you said. How often do you see founders approach you after they've signed the term sheet?
Most of the times it's after the term sheet because it was a 1-page and they said it looked fine. There's really nothing to discuss over there.
What is your recommendation? Or you or any other law firm, should the founder be pulling them in pre-term sheet stage?
Because how are you even evaluating counsel, right? Then they've had 3 introductory calls. All firms have great credentials. It's usually someone who's recommended and it's who they respect the most on the cap table. They just end up going with that person saying they've worked with me, they're great, and these are the boxes they check. So I think in a term sheet, unless some of the founders by D are more, I think, ready for it, so then they go and meet counsel well before. But sometimes when it's a seed or series A round, you have so much you're doing. You're trying to hire, you're trying to speak to investors, you're doing too much to also accommodate speaking to lawyers to find out the right fit. Fee appetite is also smaller. And I find it shocking when a founder's meeting this, they're partnering with someone for a long time. So I'd rather actually work with founders on the term sheet without charging them, saying, see if you even like what we are suggesting.
She just plugged her phone. You will get free advice. Are you saying people approach you from the company side after having signed the term sheet?
Yes,
Yeah.
and it's too late by that time.
And we would tell founders, we will not sign the term sheet unless
Till
you
you
have
get the counsel.
shown it to a lawyer. With the market is that people will corner a founder in a room. Here's the term
Sign
sheet,
in 24 hours.
And that 48-hour validity or 24
Yeah,
hours.
that's
because
it's just bad.
So I've actually had
practice.
founders who I've sent the term sheet and they've literally signed it in 2 hours and sent it back to
Yes.
me. And I've picked up the phone and said,
But
did
you
you
know
speak
what?
to a lawyer? Have you run this through somebody? And if the answer is no, but you know what, it seems fine.
But Archana, this is a very good wedge because often they would say, including some of our more
Yeah.
experienced ones, I don't want to spend the money.
Yeah.
So if then say there are people who would do it without charge.
Yeah.
they've even done their full round and then later on were advised to get counsel. We've even come into a Series B company where the founder said, I read it myself in the Series A round.
I want to switch gears to another thing. And you said exits have happened. What has been the learning from whether it's IPOs, which have been, majority of the exits, or sort of late stage secondaries or M&A, which haven't been as many? Which terms have really been tested? And where are the learnings? Like, what should we be doing differently at the early stage, and what should founders be doing differently at the early stage that actually set up the company for a smooth exit for everybody?
One really important learning is when it's an IPO, actually regardless of IPO as well, right? When a company is thinly capitalized, as in sometimes a founder just sets it up, 2 founders, 1,000 shares, 500 each. And then as the company scales, each share is sometimes worth 2 lakhs and you have very limited outstanding shares. So prior to an IPO, how do you list the company? Then what is going to be the per share price? Almost every company does a share split or a bonus issuance, right? And then you end up doing this bonus issuance closer to an
exit.
IPO, and that has huge capital gains tax implications because it's short-term capital gains tax on those shares. And it's a very complex process which investors don't want to do, but there's no other option. So early on, set up the company with a very large outstanding share capital. It's such an easy fix. Do that early on because companies even have problems with ESOPs. Then you have complicated ESOPs where one ESOP, how do you do the ratio? It's not one, it should be 1:1. So that you know at all times, X number of ESOPs translates into X number of shares, not some complicated 1,000:1 ratio. So that's a very easy fix that so many companies course correct later. So when we advise companies early on, we recommend do that process before you get your first seed or Series A round. In fact, all investors should insist on that. The other good
And when would you do it? Like how early is early?
as early before you get money in, because then as the share premium goes
Like even
up,
at seed Series A, you would say just get like...
just when the companies incorporate, have it with a large number of shares because then the founders are picking it up at face value, right? There is some additional stamp duty based on what your paid up capital is, but then that's not actual money coming in. So when the founders are setting it up, set it up with as high a share capital, outstanding number of shares as you can. Then it just gets easier. Doing it midway, then you start exhausting all the routes. You do a share split or you do a bonus issuance much before the IPO, but then someone's doing an exit, a part secondary, it'll affect them. So that's why the later you wait to do it, well before, even if it's at B and C, before there's appetite for secondary, that's still a good time to do it. But it's a tough one. Angels may end up selling, they'll be affected. So the earlier it's done, the better, versus doing a bonus or a share split is still okay, but the bonus is the more
Yeah.
controversial one.
One question to you. How often are you seeing straight or non-standard liquidation preference structures at early stage and then at later stages?
Increasingly now, in fact, some of the ones who do this quite often have learned that if you ask for 2x when you're coming in at Series A, it's going to come out of your pocket because
Yeah.
every investor is going to do it.
But do you still see
But
these?
we're starting to see a 25% IRR or a 1.5.
Even
and
at
that's
early
shot-
stages.
And at Series A, and we've told the investor this is going to impact you. And we've asked the founder candidly, have you asked for a very high valuation? Because is that coming to bite out of
Yeah.
this, right? Because this will impact you far more, because how do you just offer 1.5 to you? You won't have any cash coming out to you. It's not very common, but at least 2 out of 10 term sheets are starting to have some sort of minimum
Return threshold.
on the LP. Forget consent.
Yeah.
Right?
There was something on, actually, Archana and me had worked on it together. This was on liquidation preference and what it really means. Everyone just said straight 1x, but or versus a participating or some other multiple. But how LP is actually supposed to be calculated in different scenarios, I mean, it's a beast. And just coming to the other point, Avi, I know we've had IPOs in our portfolio, and I would love to hear from both of you. What are the things that need to be set in place very early in the company's journey so that the exit is future proofed, right? Where we aren't sort of discussing things at the last moment before the company is filing for IPO or before the company is doing a large kind of M&A sale. Are there things that founders should keep in mind and investors should keep in mind in terms of what is now market and what is considered to be best practice?
So let me go back to liq pref for a second, because I want to re-emphasize that it's probably the most important term that founders still don't understand. So they should listen to your podcast. I learned it the hard way because I had 2x participating preferred in Bazi. And then when I was working with John Doerr at Kleiner Perkins, and I remember he had gotten me involved in Clear Trip. And it was a very simple term sheet. Not simple in terms of 2 pages. It was maybe 7-8 pages. All key terms, simple 1x non-participating. And if people are not understanding what I'm saying, therein lies a problem. Go to ChatGPT, understand all this, listen to the podcast. And basically, that's where I learned money is not made on terms. It's made actually when the business becomes successful. But it is, to me, the only term that really, really matters, other than valuation and some of the other ones. So I think that's critical. In terms of IPOs, the history so far of IPOs is, what is the average duration of a company that has gone public? How long would they have been in existence?
8 to 12 years. It's coming down, but yeah, broadly in that range.
Going forward, it'll be 4, 5, 6 years. So what happened therefore is a lot of the SHA renegotiation started happening. But now an SHA by definition, and again, people may not know it, it gets dissolved when you go public. That's a great reason to go public. If you don't like your investors, go public. They have nothing on you. So, but prior to the dissolution, then people are trying to renegotiate, because the founders can't go negotiate with public market investors. Then they have to call an AGM and it goes to a shareholder vote, right? So I believe companies will start going public now in 5, 6, 7 years. There's a separate IPO podcast that we should link to, which talks about, in my view, that you need to start 2 to 3 years prior to when you need to be trading, doing a bunch of actions. We didn't in that podcast cover corporate actions and legal actions, but that also has to be done. But some of the other things are even governance. So when we talk about governance should, today in India, is largely SHA driven.
Yeah.
And it's largely the investors who are on the board. As you go public, it has to start graduating towards board government. And when it graduates towards board government, you need to start setting in committees and processes, audit committee, all of that should actually be firing for 4 to 6, other than your numbers. All of this should be firing for 4 to 6 quarters before you actually go public.
Actually, you've said this earlier, put the governance in place ahead. So what you would ideally want to do at pre-IPO, actually start that, in your case, 4 to 6 quarters ahead or 6 to 8 quarters ahead. But at every stage, for example, I think we've spoken about a single investor having a veto. Oftentimes, it's only us investing at the seeds or the Series A stage, but we still start with the investor majority structure because we want to keep it scalable for future rounds as well.
If it is investor majority on the board, are investors going to be okay with that? So you have to start having this conversation, because some of these can be solved But again, it's documentation subject to approval of the DRHP, right?
Yes.
So often you will find that the entire construct changes around that time. After which it is going to be governed by public markets.
Correct.
If the public markets don't like what you're doing, they will show it in their stock price. We can't do that, right? So I think the takeaway is that there are changes, but people just start too late.
Yeah.
They need to be thinking many quarters before.
Yeah.
And this tactical point, by the
Yeah.
way, it's a very material
It's very-
point on capital gains.
Yeah.
People just miss
No,
it.
we're going through it in some of our companies
a
as we
lot.
speak, and we're like, oh my God, why didn't we do this like
just
2 years
solve
ago?
for this much earlier?
Yeah.
Yeah.
Right.
In fact, there are times where I remember we actually had an option to take an exit. And because the company had just taken a bonus and a share split, we said, listen, the cap gains on this is just ridiculous.
Yeah.
Let's just wait for,
And not do the
maybe
enough
6
of
months or 1 year or
wait
whatever
later
and do it.
it on there.
I want to come back and maybe, you would have seen this in cases more than, we have just given the volume of deals that you're involved in. There have been a bunch of governance things that have happened in the ecosystem, right? Hopefully that's all behind us. But do you think a tighter term sheet or tighter SHA could have prevented some of those?
No, not at all. And this is what we see. The more governance issues come up, people are adding more stringent clauses and rights that you're looking to enforce when it's already too late, right? That's why reverse West was earn your shares over a period of time. But if it's caused, we'll go take all your shares, even 10 years later. And that's why it gets negotiated for so long. But where is the founder, let alone his shares, when he's committed that scale of fraud? The fraud realistically happens when there's some money to actually take out, right?
Yeah.
And then at that point, the stakes are so high, he's then hiding somewhere. I mean, that's common pattern. Or it's so early on that there isn't actually the amount of effort and money you'll spend trying to enforce, trying to recover
Yeah.
the shares. The company is already in the press for this instance. So I feel like the clauses won't help. It's the way those information, that's why I think actually even saying a good auditor doesn't help. A lot of companies did have that, right? Because you're relying on the founder ultimately to give that information. Having more stringent, what else can you get other than monthly MIS, right? Because you're getting all the information from the company. But if everything is cooked, how can an investor really roll up their sleeves and figure things out early on? So it's like you have all of these rights, you have inspection rights, but how do you really sense commercially something's going way off to actually trigger that forensic audit? Or we've all thought about it for a while, especially as legal counsel, what are safeguards to prevent it from happening? But there's just been no magic wand answer to that. There's just deterrence. There are things so that a founder knows that there are serious consequences, but you're smiling, you're like, why haven't you figured it out by now?
Well, 2-3 points. One, I want
Yeah.
to ask. So my view is exactly the same. You cannot legislate against malintent.
Right.
Right. So, Tarun, we have been in many such situations where we have walked away. So I think our view is prevention rather than, and I'll come back to cure. But any points on that?
So one is, I think nothing works better than prevention. I remember very often when founders will come to present to us, and we love everything about the company and about the team, but sometimes there is a smell test, and we've spoken about this. That what is the journey going to be worth it? Because maybe I've heard something about what they've done in the past or whatever it is, and people change, and you always want to give that benefit of doubt. But the question is, are you ready for that journey, right? I think for me, the biggest is we have avoided some of these just because of extensive referencing that we've done. And in my mind, honestly, that's the only thing as an investor you can do, because once you wired the money, honestly, there's very little in your control. And I agree with you that you can't legislate your way out of just malintent. I think what we've done, and I feel the two most actionable things that one, actually Sanjeev Bikhchandani had told us in one of the sessions we had, and I really loved that, which is board appointed CFO or investor appointed CFO that actually takes a board seat.
Great idea. How did that go down? Did we try to put it in we tried to legislate it in our SHA. I remember telling her, let's put it, no, Rohan and her.
No, so what happened? I'm not aware of this. So this...
No other investor wanted it, no?
Then it's like you are accountable for it, right? Like who's then, it's a board appointed CFO.
Yeah.
That CFO is ultimately still working with that founder.
But if they have to take a director position on the board,
how does that
these are all
anything?
professional.
No.
Highly
I thought
professional.
one of the other issues became that we tried to put in what Sanjeev's suggestion, which I continue to agree with.
Yeah.
Board appointed CFO reporting both to the board and the CEO. Audit committee meetings without the CEO. Founders threw up all over it, which by the way, I do think should be the case. If I was running a company and that term came, most founders would say, do you not trust me? Well, if I trust myself, why do I have a problem with this?
Right.
Actually, the best founders say that.
Yeah, I trust myself fully. Actually, many of our founders today say, "आप लोग का CFO क्यों नहीं attend करा हमारा audit?"
Yeah.
Right. So, I would 100% sign up for it. Some founders, we tried this 3-4 years ago. Some founders resisted it. They went whining to the other VCs. The other VCs came whining to us, saying, "We don't need it." So,
And also committee,
and therefore it ended.
that change clause which says the investor has a board seat and has the right to be on all committees. So then there's no point of creating a committee if everyone, the same composition is going to be on that committee. And which investor says, I'll defer to this other investor, let it be a concentrated committee
Yeah.
or just X, Y, and Z. Everyone then wants to be on that committee.
Which is a maturation of the VC system
Yeah.
issue.
Right.
I don't want to be on the audit.
Yeah, of course.
It is just crazy amount of work.
Right.
I am not the most competent person for it. But should our head of finance and
Somebody,
other head of,
Right.
No, so
but I think people haven't gotten there yet. With IPOs, realizing that this is normal governance for public companies,
Yeah.
I'm hoping that some of this will
Will
start.
actually change.
No, and I remember Sanjeev actually making the statement that some of these things are done to save you from yourself.
Yeah.
Right. And there are times where we have seen as companies raise crazy amounts of capital, suddenly there's, this whole sort of media glare.
Right.
The smartest people start doing stupid things. And so the idea was, these governance things are actually to save you against yourself.
Yeah.
Right. And so I actually, my limited point with the CFO thing, I love the idea still. I still think it should be done. And I, as a founder would have been very happy to do that. Is if the CFO is putting his neck on the line, his or her neck on the line, and they're actually taking a director's seat,
Right.
they are liable. These are professional CEOs. These are not like founders or family members of the founder.
Right. And that itself is tough, right? Because being an executive director on the board, you are going to be liable for everything
Yes.
that happens in the company, including tax claims, everything comes to you. So finding that CFO willing to take that up, then it becomes a cost issue. Can you really afford that CFO willing to take on all of this and the implications of all of that? So finding the right fit.
Yeah.
Sometimes the founders worked with the CFO for 3 years, has had a good equation, who will face some friction on terminating and just taking on someone altogether new at that stage of the
just completing the thought, Avi, what you had asked, I think the second thing is internal audit. And I know we've now implemented that across, most of our companies at a particular scale or higher. I really think, again, the best founders actually appreciate it.
Yeah.
They have come and told us that, listen, this was a hole. And the fact that as my company is growing so fast, there is actually some sort of, process checks and balances. It's actually helps me sleep better at night. Because sometimes it's not intentional. As the company is growing, you have so many people doing different things.
Right.
The founder is not into the weeds of everything. So,
Yeah.
so that's the other one. Okay, I'm going to shift gears a little bit. And I think, Avi, you had mentioned this in one of the earlier podcasts. And I have swung in different ways on what's the right thing to do, which is founder majority on the board.
Yeah.
Right. We've been in multiple situations. I think founders are enamored by stories of Facebook and Google of these super voting shares. In India, we've seen, founders say, hey, but you know what? Why should founders not have control of the board? My current view is boards should over time represent or mimic shareholding.
Yeah.
So you can't have your cake and eat it too. You can't say, I'll keep raising external capital, but I still want to be in control of the board.
Yeah.
You had a choice to be in control of the board, don't raise money.
Yeah.
And there are founders who choose that path, and that's a great path to take.
Yeah.
So that's where I net out. But I also see the fact that as investors, we have a lot of safeguards just through SHA, through affirmative vote items, veto items.
I don't care about boards. I don't care. I think Indian companies are governed when they are private by SHAs. US companies are governed by Delaware law, which has a very strong board component. So here, if you get into a dispute, you're going to show up in NCLT, which is an SHA.
Yeah.
Right? So I don't care as much about the board composition. In fact, I was just talking to a founder and advising him because I always think founders first, having been a founder. In fact, if anything, I am okay giving founder vetoes once the cap table becomes heavily skewed against the founder. I think if a founder has put many years into building a company, the company should not be sold out from under them on a whim and fancy. There should be enough safeguards. Ultimately, we are investors. If you're not giving us an exit, we'll have to do it.
Yeah.
Right? But not on a whim. So less focused on board early stages, much more focused on board later stages, which is also a view that has evolved over time. because now it's out IPO backwards.
Yeah.
When it wasn't IPOs, then it was actually I didn't care about boards at all. Now, in fact, if you ask me, my personal preference, and you know this for the firm, we shouldn't go on boards.
Yeah.
Because before we are investing in companies to ultimately for them to go public. We will have to step off the board before they go public because we then become
exit,
insiders,
yeah.
we can't exit. If that is the case, why go on the board at all? It is fully governed by the SHA. Yes, we would like to attend board meetings, which we have a right through the observers.
Just taking a contra view on that, do founders sometimes see this as you shirking your responsibility?
So I tell the founders very clearly, I don't want to join the board unless one of four things happen. You force me to. You need it for regulatory reasons. You need it for reputational and branding
Credibility
reasons.
or whatever, yeah.
Yeah, so reputational branding, or you need it to balance the board because of investor set. No one has triggered any of the four. No one has triggered. Many have said that reputationally it will help, regulatory it will help. Then I go back to them and say, is it really me? Or if you were to in a consumer company get a PNG guy, will it help you more? Will it prepare you better for an IPO? If for regulatory reasons with RBI you think this will help, would somebody of a higher profile from financial services help?
Yeah.
Do you want a person to come on your board who will then have to step off before IPO?
Yeah.
No one has triggered it.
What's your view?
Actually, and I've asked our own founder clients because they've seen 5 investors and it's 2 in founders, and they wanted to be a little bit more equal, not to be in board control, and you fight a lot for that additional seat. Can't be a family member, of course, the signaling issue. And then you add so many things, has to be an industry expert. And you put down all of these things. But I've gone back and checked with the founders. Did you even find someone you wanted to nominate? Because if it's an industry expert, he's a founder, he has restrictions being an executive director elsewhere. And how does it actually help you? And I know we have 3 live deals where we're asking for it, but I've not got the answer.
I'm against you on that deal. I know which one you're talking about.
But it's I think just having more voices in the room, right? Like if you're trying to implement something, and let's say the investors want to exercise their veto and say, no, that's not a good idea. Maybe new line of business. I think founders have just said it helps to have someone else weigh in. It's just a voice at the table, like the same reason why investors just have an observer seat. You can't block, you can't vote, but an expert having a view on it may just help investors have a different view. It is tough to get the right person. So founders have used it wisely. They've not really implemented it just to have someone else there. They like to have the ability to nominate that person if they find the right fit, someone who can actually add value, and they think that will help board discussions be more meaningful. Because investors, yes, they're on the board, but they are also thinking about what's in their best interest, right? They're not, in that sense, you're supposed to have fiduciary obligations and act in the best interest of the company. But it is a gray area, it does get blurred. And then that's why the whole ask of, I'm not even trying to control the board. I just want an additional voice at the table. And I see that more often with even solo founders, because it's one founder, you have a lot of investors, and then it's just to facilitate discussion. So it's a softer point, and founders are not able to understand why there's so much resistance.
Yeah.
Because like you said, investors are protected by vetoes. You can't do most things without getting investor consent. So what's happening at the board? You have 15 things. They can't even hire a key employee without coming back for consent. Forget M&A, fundraising. So many operational things, debt, capex. So that's why there's this divide of founders saying, why are they resisting? And investors saying, why do you care? You are running the company. You are the CEO. Just come back to me for consent. Investors don't come in with their 5 board seats and come together and make decisions for the company, right? So it's a bit of a...
I would say net for founders at the private stage, I see them sometimes obsessing about it.
Right,
Maybe 20-30%. They shouldn't.
It doesn't move the needle.
The public company, when you're getting closer to, obsess about it.
In fact, yeah. Switching gears a little bit, what's one term, and I would, this question is actually to both of you, 1, maybe 2 terms at most, that you really think founders should care about, that they actually don't care about as much as they should? And what's one term where you just see founders obsess about it, but honestly, it just doesn't matter?
I wouldn't say it doesn't matter. I think the
or it matters less.
Controversial one on reverse West, right? That's the hottest
one.
I
was hoping you bring that up. Yeah.
And lawyers don't like discussing it because everyone's been on both sides. And both sides come at it at 2 opposite extremes. But actually more mature founders, I'm seeing them increasingly move away from it, saying, I want what's in the best interest of the company, right? It's not a me founder versus investor. I think many people approach it.
I think that's the
very flawed
what's
premise.
Right for the company. Yeah.
Right. It's a flawed premise. Investors don't even have the ability to take these shares, right? The standard clause is company will claw it back, ESOP pool is stopped up. It's to salvage the company so that another CXO can fill up that position. So I think the way the council positions it to founders changes the way they approach it. So sometimes the way they approach it is, oh, this is such an unfair clause. I have very low salary. I'm putting my life into the company. And now you're saying you can take away all my shares. That's the approach. And that's where things go haywire. And someone needs to have that offline conversation saying, if you are the one continuing and the other person is resigning or just not performing and needs to be let go of, what do you want to be the fair construct, and flip the circumstance? Because if you're approaching it as I may be out of here, how many shares can I leave with? That itself gives you a very, the signaling issue that founders sending itself creates a lot of issues. So I think it goes down a never-ending track. It's a critical clause. It does matter, but in an early stage company, in the 1 to 3 years, if the things are going south, if it's difficult quarter and a founder wants to leave, it's already it's a red flag situation. So I think if they approach it differently, it's great. The one clause that founders tend to ignore, which we talked about briefly, right? When you're doing a Series A round and you see 2x, and a founder's thinking, okay, I want to sell at $1 billion and I want to sell at 800 and something, you're raising 5 million, they're like, yes, what's 10 million? I'll blindly return 2x. That's very easy, or 25% IRR. And they don't realize that in your 6th year of fundraise, people are sitting with a 3x, 4x return.
And it becomes a precedent. Every new guy is going to ask for
right.
it.
So that LP clause reads very straightforward. But I think even if they see a 2x, even if they see a 25% IRR, first-time founders, I think that's a very fair ask, that they're coming in, there's an 8-year horizon. Of course, I can provide them an exit without realizing that once you agree to that, it's just never coming out. So I think that tends to get undermined because you're not thinking how many rounds of fundraise you're going to do, and can you guarantee every investor at every stage 2 to 3x. And it hurts a VC is not investing to get 2x anyway. So it's so bizarre to say 2x return.
What about you, Avi? One which you think founders spend too much time, which is just immaterial in the larger scheme of things?
Well, it's not immaterial, but I think it has. So EOD, event of default. So first of all, some of these like liquidation and all to me are
just hygiene.
And Astral has got closer years.
Black and white.
You should put the term sheet into ChatGPT and say what is market, what is not market. And things that are not market, just say NFW, which she knows very well what it means. No, I think
she learned. And I remember asking us, what does this mean?
And I've been saying it so many times, and now I've finally stopped because people ask, what is NFW? And
ask Avnish.
I'll send them to you.
Yeah. So I think things like senior lick prefs, this, that, they are just not market. Just move on. This investor is not thinking the right way.
Yeah.
Now, I'll tell you what is not market in the US, but is market in India is EOD. Somehow and I think it's event of default if something happens. And it is, honestly, if you ask me, that is a clause as a founder, I would be pissed by also. Because it has very drastic consequences. And then there were some founders I was advising, and I know she and I have discussed this quite a bit. And then the final solution that came out, if you keep resisting a clause that's market, you're going to lose because it's market. You'll try to get another term sheet, it'll have the same clause, right? The way to think about in event of default, just to explain it to people, is if you do bad things, what can happen? If you do bad things should happen, right? By the way, going back to a previous point, you said there should be consequences. I don't, to fraud and things like that, I don't believe there have been enough consequences. I think in the last 7, 8, 10 years, a lot of the people who committed fraud publicly, the big industrialists have been put in jail. I think the people who are committing fraud in this industry should be put in jail. Nobody has pursued that, but they should. That will teach people the lesson, because that's not what you sign up for, because you can't legislate, right? But unless today, if you look at our industrialists, and people are like, okay, there will be consequences. This is not the old India where you take all the debt from the banks and convert it into your personal equity in London and run away with it, right? So I do believe fraud should have consequences, and it should have drastic consequences. Now, if you do bad things should happen. Now, that not always is it criminal. If it is something has happened, you have committed some other thing which is a posh violation or something like that, right? I think of except the the solution is to separate trigger and consequence. The consequences will be terrible. You might lose all of your equity. There may be court cases there. Nobody, if you look at most legal documents, it will say, notwithstanding all of this, we can do everything else we want, right? But if you've done bad things, that's what should happen. But the trigger should not be frivolous.
Yeah.
So what I advise founders is focus on the trigger. Some will say, I want a conviction by the court of law. Now that's a very, 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 very high bar. That takes 10, 12, 15 years. Maybe it could be framing of charges. Maybe it is arbitration proceedings. So I think event of default people obsess because the consequences. But I think the way to think about it is, if you were on the other side, are you really asking that you can get away with anything? You can get away with murder, basically. You can't, right? So I would focus on trigger being fairly strict, consequence being very tough.
Yeah.
And consequence, then don't worry about it. Don't trigger.
Yeah. And the only one I would add is a cure period, right? Because I've seen founders who sometimes come and say that, listen, you triggered it and then the consequence is so high, but did you give me a chance to actually correct what may potentially be out of line? And so I think giving a reasonable cure period, because then you know that at least the intent is to fix things. That's there. On this trigger, there's a lot of nuance. What's a fair balance?
And what's market now?
It's largely the charge sheet or framing of charges is actually quite fair because that's the magistrate accepting it, because charge sheet and the police post FIR, you can get a charge sheet done. But it's not just that. Then you have for frivolous.
Sorry, just interrupting you for a second. And Tarun, this is important. Lot of founders, I think in India, correctly resist that FIR should not be a trigger.
Right, because that's
you can bribe a cop and get an FIR.
FIR is very early, so that's why you need some amount of investigation to happen. And even then, post the investigation, if there is a charge sheet, the founder has to be given at least 90, 120, some amount of days to at least have some clout if this is frivolous to get rid of it, right? Because this has happened in the past, right? Stacey Yogi was just thrown in jail, and then you need to have the ability, and that, of course, the entire industry, you were very supportive of that, right? Everyone helped to get him out, right? So that's the thing, the trigger. But again, taking a step back, which is what we've told a lot of our founders, right? When you have a strategic, it's different incentives, but when investors on the cap table, and of course, you can always sell, and later on, there's a strategic, so we should have guardrails. But again, the messaging to founders is that investors that want to make money out of this company backing you, if there's something frivolous, they want to problem solve this. In fact, even if there's cause, how does it help anyone? It's very difficult to terminate a founder with cause. You want to actually reach a settlement, incentivize the continuing founder and move forward. It's not, because what is the main remedy then? Accelerated drag. How easy is it to find, or rather difficult to find an exit even when things are going great, right? It's not easy to get exits. IPO and stat sales are all there in documents, but it's not easy. How are you going to find a buyer when there's been a serious event? So even if you have a high trigger, the consequences are not easy. It may seem easy to a founder because that's his company and everything is at stake. So you want to have guardrails, make it watertight. But I think also realizing that no one stands to benefit by having this hair trigger, however it's worded. So even when you have things like that, charge sheet, all of that, it makes it fair, and then founders sleep better at night. But we've seen unfortunate circumstances, or like you said, you have so many portfolio companies. Who has the bandwidth when it's very early stage at Series B? Will you really invoke it? How much money is at stake? Or do you just cut your losses and move on? That's been the sad.
So on this point, is it now market to insist by investors like us? I genuinely don't know the answer. For the founder, CEO to enter into an employment agreement as part of the...
Yes, they all do. They do have
an
employment
agreement. Does it then have resignation for cause, without cause?
Yes. And the consequences are in the SHA. But the employment agreement governs how the company can terminate, how many days notice.
And then where is performance included there?
It's never, because how do you define it? If you say business plan,
especially at the early stages.
And so I think that's something for founders to take away. That because I have seen people slip in performance and founders resist, and founders are right. Because if you're doing early stage investing, you're taking that risk. But people have tried to make gross negligence, performance, all of that triggers for
gross negligence can still be grounds for termination. But what are the consequences? Gross negligence versus negligence, unless you define it. You can say anything is, as a founder, you ought to have known. But it should, and again, that's been learnings. I would think a founder should not be terminated without cause. That was my earlier view. Thinking that's too unfair. You have cause, you have breach, there has to be wrongdoing. He's not an employee, so you can't terminate a founder. But then we've seen really unfortunate instances when there's been bad behavior on the founder, a very difficult co-founder dispute, or where one founder is being obstructionist. You can't invoke cause. That's very tough to actually attribute it. And even if you want to reach a settlement, you have to terminate without cause, have an exit agreement, even if there's some worst case payout. But if the employment agreement doesn't allow you to terminate without cause, that gives a founder excessive leverage and telling
So
founders.
that's a very interesting one. Let's say we have back two co-founding
right.
team, and they're just not getting along. And it was very clear that one was the key,
Exactly.
and who was the CEO, and then
Yes.
there's. So you actually need to, unfortunately, let go of the other co-founder.
Yes.
So how does one enforce that?
You use the without cause termination.
So it's there in the agreement.
It is there, and that's why some founders want accelerated vesting, and then
So
saying
that's
that
a separate, that's a consequence. But
Yeah.
you're saying the trigger,
should
but who
be.
can trigger the without?
So that's again the
Investor
company.
majority.
So it's the board that will exercise it for the company. So it'll be the continuing founder and the investor nominee.
So we actually had this, and I'll share an anecdote. And these are not as often spoken about, and it's
Right.
not pleasant. But I'll just share it because it's good learning. So we actually had a company which had, I think, 3 or maybe 4 co-founders, and the company raised a lot of capital. There was this one round where there were investors just fighting over each other to invest in the company. One of the earlier stage, and in that, because there was so much demand, the founders tried to slip in that the firing without cause has to be removed. Now, one of the seasoned investors who was a co-investor with us on that cap table, he said, okay with everything, this one thing I will not agree. And he said, if the round blows up, let it blow up. At that time, I think all of us, including me, were like, okay, now we've actually worked with these founders for so long, why are we resisting this so much? We have enough information now. And he said, you know what, things change. And as it turned out, a year later, actually there was serious conflict. Actually, it came to a point where one of the founders had to come and tell us, listen, this is becoming dysfunctional and I need to let these guys go, but there's no cause.
Right.
But we're going to destroy the company if we don't change
Right.
something. And the only reason we were actually able to even, salvage it and put it back on, hopefully on a turnaround path is because we actually had to have that conversation with the founders.
Right.
And so it just gives you a little
Tell me
bit
the co-investor later. I want to bring them into more companies.
it was
Good judgment.
It just, and again, the idea is never to misuse. And I think this is
Right.
that founders get wrong. See, our job as investors is we are not here to screw you over. We are here to protect the company when shit hits the fan.
Right.
And sometimes these clauses, I mean, if we were misusing and, triggering these clauses frivolously, I don't think we would have the reputation we have.
Right.
Yeah.
And it's not
and
happened
also
in the
what
industry.
Exactly. No, and also what you said earlier, you came back to it also in the last. We are here to make money peacefully.
Yes.
Yes.
Exactly.
You don't want to roll
In
up
a
your
good
sleeves and
relationship.
run the company.
We are
right?
not here to
Yeah.
speak to. That's the only objective.
Right. And I think then founders start relaxing. Yes, okay, why will an investor terminate just like that? You hear these examples. Oh, what if they don't like my face tomorrow? And why
Yeah.
would an investor get their hands messy and turn? So you should have the without cause. That's been my learning. Earlier, I thought that was
Yeah.
a founder should not sign up to it.
Yeah.
Now realizing when you're in teams, especially, and if it's a solo founder anyway, that's the guy you're backing. If there are performance issues there, it's
Correct.
a bad bet.
Yeah.
So
Right.
Also very different from US context. I think what happens is so many of these early stage war stories, the media, all of this is Western
Yeah.
context, where I have heard terms like bounce the founder, bounce the CEO. I remember the first time I heard it
Yeah.
from the
You
investor.
actually cringe.
What if we want to bounce the founder or bounce the CEO? I'm like, and I told that co-investor, which is the opposite of the co-investor example you gave. I said, I don't want to work with you because that's not how we think. That's not how we invest. I'm not here to bounce the CEO. I've been a founder. I would not want to be bounced.
Yeah.
But that lot of these clauses historically and some of these things have come from that
the
context.
US. Yeah.
I don't think that context applies, by the way.
Yeah.
Right.
No, in
All,
most,
all the public companies today, digital, newly invested,
it's all
are
founder
being
run.
run by
Yeah.
founders. By the way, the US context has changed, where people now talk about founder-led companies with Elon Musk, Jeff Bezos, Steve Jobs after he came back. It all changed. The narrative changed.
No, and I think I don't know why the context is different in the market. Maybe it's because US has a much larger bench of professional for-hire CEOs,
Right,
so to
CEOs.
speak. But in India, we've just seen it never works.
Right.
Actually, trying to replace a founder that we
Founders,
back
very different.
by
right.
somebody else and expect that they will turn it around. The examples are very few. and
Very
far between.
handful of people to even find in that. And where that person with even 20 years experience with a young D2C brand, very different market, and it's very tough to actually replace a founder.
Okay, I know we're going to run out of time, so I'm going to just switch gears into 2 last topics that I want to cover before we conclude. One is you advise founders all the time as they are negotiating with investors. Oftentimes, you're also on the other side of the table where you're representing the venture firm that's investing. Obviously, you've seen both sides of the table. One thing that oftentimes founders don't think as much about is, ek baar valuation हो गया, एक बार funding हो गया, the term sheet negotiation, how that is such an important opportunity to actually test the relationship and test the maturity and durability of the relationship. Sometimes I feel people lose that perspective, right? Either they just agree upon everything without reading, or they treat every term like, this is life and death, and it gets really contentious.
Right.
What should founders learn on how the best founders actually do this, right? Because there is a maturity. What have you seen? How do the best founders negotiate? What are things that as investors we should keep in mind in terms of, internally we have this thing that, listen, every interaction, especially at the early stage when you're still not part of the company, is an opportunity for you to further evaluate whether this is the right investment for you. Right. Now, we also don't want founders to be super cagey and not, speak their mind because they're saying, oh, I'm being evaluated, right? Yeah. So what's the right balance?
So actually founders, that's been my view, that a lawyer will happily give you 20, 30 issues, right? And then that's how we do our job, by saying these are all the possible issues. But quite a few founders say, I really can't get involved and I don't want to battle everything out. What are the top 3 issues at this stage of the company? Very few ask that question, but I would say not everything is a Series A issue. Some, yes, once you sign up for it, it's going to be very tough when you have 8 investors. How do you revamp it? But certain things you do have to fight that battle at much later on, right? Like your exit decision making, all of that. But at Series A, what would be relevant? And in fact, the truth is, at Series A, many of these companies are pre-revenue. Your warranties and indemnity doesn't even mean anything. There's not much. You've not filed taxes. You don't even have, 6 months of quarterly, your financial statements. So at Series A, there's a lot less. Even if there's a long list of laundry vetoes, you're not going to do an M&A. You're not planning to take on debt. So actually taking a step back and realizing at this stage, what do you really need? So I guess reverse vest, making sure it's fair, good triggers, all of that. The warranties and indemnities really don't mean much, but you'll have your safeguards so that it pans out differently. So it's with founders who've always asked us, tell us what is critical. And if it's not market, I don't want to waste my time. Because sometimes you get mentored by someone else. They'll advise you on what they got in Series E, like things like this, founder vetoes and certain aspects which don't really fit that early on. So when they've asked us that and are happy to defer to our views, then that's helped the deal go forward versus just posturing for 3 months and delaying the round when you can pick it up later. So that's what I've seen from a founder standpoint. I think investor standpoint, most of the terms are broadly the same, right? No investor comes with different headings. It's the same headings. I think just some relaxation on, like the laundry list of vetoes. Is it 20? Is it 10? Are they must-haves? Do you really need it at this stage of the company? Being more lenient with what the founder can do, as in not any ESOP, maybe something more meaningful, because you don't want them to exhaust all ESOPs upfront. Is it 1%, 0.5%? So upfront is giving them some leeway versus just saying for any little thing, come back for consent. I think small things like that also do make a lot of difference for a founder.
Avi, what have you seen? How do the best founders differentiate themselves during a term sheet negotiation?
Look, I think the maturity comes in by understanding the other side's point of view. And I think that's also, I think that is the investor's job, not the founder's job. The founder may be likely doing it for the first time. You are not. So for me, the tough situations I have, by the way, forget even in a term sheet. Yesterday or day before, I was in a board meeting where one of the topics was, when should we raise money? Okay. And I got to that topic early in the meeting, and I told the founder, put up the spreadsheet of your projections. And then I asked them, if you were an investor, where in this time period do you get more confidence? All of them had the same answer, which is our answer. But that is different from the answer which they had before, right? So people change their mind. What you have to understand is, most people change their mind when they have new information.
Yeah. So changing the perspective maybe is... Yeah.
Give the context. Change the perspective, give the context, and people reach the right answer themselves.
Yeah.
The situation I was telling you about in terms of this particular founder was saying, I don't really care about XYZ, and I really think they should. But me telling them they should won't change it. I said, okay, now imagine this situation. Oh, that's not acceptable. I said, but that's what you're agreeing to. So that's what works for me. In terms of negotiation, I do find the term sheet, and you and I have discussed this ad nauseum. you can predict how the company will go almost with the term sheet.
Yeah.
Because if they are so focused on
The
micro,
minutiae.
that's what they'll do throughout the
The movie is never different from the trailer. So-
It'll be exactly that. Why don't you come in with what you think works?
No, so I think, there are times where, listen, I think my learning is in a investor-founder relationship, the times that the relationship is tested and when there is a fork in the road between what may be right for the founder versus what may be right for the company versus what may be right only for the investor, there are very, very few crucible moments.
Right.
And oftentimes when we are investing, those crucible moments have never been experienced. And so oftentimes we have discussed internally to say that, the way the founder, what they focus on, most importantly, what they focus on in the term sheet negotiation tells you a lot.
Yes.
And there have been times where the founders have focused on completely wrong things. And it has influenced us on whether we should double down on that company, whether we should stay away, whether we should even proceed with the investment. It actually tells you a lot.
Right.
Because if
what
they
they're
are
focusing on with us, with you, is what they're going to focus on with their employees, is what they're going to focus on with their customers, is what they're going to focus on with their partners. And if they're missing the forest for the trees here, they're going to miss it there.
Yeah. Okay, final thing. We can't do any
Tarun,
podcast.
I'm going to interrupt because
Sure.
I think one important point we haven't covered, because this laundry list of reserved matters
Actually,
kept
yeah, that's a
coming
good
up.
point. I missed that, yeah.
So I believe that, and this is counterintuitive for founders, they will say, which sounds reasonable, I am a concept stage, early stage company. Why do you need 20? And that's why you need 20. Because we have just started with you. When you grow up, when there are more things, it does change. And I want people, and again, linked to, we have covered this in one of our podcasts. There are 3 types of reserved matters: operating, governance, economic. We are minority investors. We need protection. You are running the firm. You don't need protection. You're running the company. So economic will never be compromised. That's our rights. We have put in the money for it. That's what our investors give us money for. Operating are the ones I like to relax the first.
First, yeah.
Probably I'm the most lenient even at entry because we are founders first. We trust the founders. We don't want to get into every minutiae of operating. Governance also should change over a period of time.
Yeah.
So basically what should happen is that laundry list should keep getting separated like this and keep getting either diluted or the thresholds changing. For example, when an investor is early in a company, we will always have veto rights over our own economic life. Nobody can take it away from us.
Correct.
But should we have veto rights in all governance and all operating? Absolutely. As the company grows up, it should be a smaller list governed by a larger threshold of people governing.
Right.
And I do think maybe laying it out up front, saying this is not your permanent life.
Yes.
This is your temporary life.
Yeah.
And over a period of time, this life will change, will help people.
Yeah. No, and the logic over there is if it's right for whatever the threshold, maybe 2/3 or 75%, if it's right for 2/3 of the shareholders,
You can go
it's
for
right
it. Will go for
And again, like you said, right, that it's not going to come up. This company shouldn't, or the idea and the business plan was you're not supposed to raise debt in the first 2 years or even 3 years, or it was on the cards that there will be a round of venture debt 1 year post closing. So when it's going for plan, then it's straightforward. But if you are going beyond that, doing certain high risk things, then investors should have consent.
The other thing on the operating thing, because I think that is generally where founders have the biggest pushback. I think the economic and governance, most of them get, and they also understand it'll get relaxed over time. My learning is if you align on a business plan prior to the funding, and then you say, listen, X amount of variation to the business plan is fine. But if it is exceeding that, then there needs to be a discussion, right? Or a revised business plan approved by us. I think generally founders are more amenable to that.
Right.
But if it's an absolute number, any debt above 10 lakhs,
Yeah,
it's
the number
fine,
is very
or
tough
any
you
capex or whatever it is,
painfully
then they're saying,
that
listen, you know what, at some point I'm going to have 5 shareholders. I can't keep running behind. And some of our peers are also infamous not for replying to some of these things for weeks at end. They're listening, I can't slow the company down. So I understand the perspective. But the idea is, listen, if it's part of your business plan anyway, you're not expected to come and ask us every time, right? Because we've already approved the business plan in principle. Okay, switching to the last topic, and we can't do any podcast today without talking about AI. So I do want to talk about...
do you have job security issues?
I think it's great for a young firm like us. I think takes away the need
Actually,
for
I would love to hear
A1
your
agents.
view on that. So the question is exactly what happens. There are all these legal sort of AI companies out
Right.
there. There's ChatGPT. Avnish was just saying,
Right.
put the term sheet into
ChatGPT
ChatGPT and
itself does.
put it into. So then, why do they need a lawyer? And what are you seeing change with AI and legal documents?
Right, because again, I don't think the AI is trained yet to see what has happened in the industry. Things like this, right? AI has told one of our founders that if it's without cause, accelerated vesting, that's the right path because you're letting this founder go. But that's not what is reflective of where we are. And with VC investing, it does take a different turn, right? When Avi raised, it was 2x participating. Industry is course corrected to 1x. We are wrongly seeing 1.5 making a comeback. So I don't think ChatGPT is going to tell you for that context, that company, especially when you said you want to invest, but there's probably the third co-founder with 8%, not the right fit. So that's why I don't think with negotiating deal terms, of course, with sectors, even if regulations change, AI is keeping up with it very well. So I think it does make our life easier when you're doing a diligence. You need, what a senior partner is doing, reviewing work, you would just review or you probe with more questions. So it's made my life a lot easier. It's made hiring more effective. You don't need to have an army of 20 people doing a late stage M&A diligence. You really need more effective thinking to see someone, a senior person will at least keep track of big ticket changes in law. And sometimes, a kid may lazily pull out something that's a bit outdated or wrongly. It does hallucinate. I've given it a clause sometimes and it gets it drastically wrong. And intuitively, you would know no one would sign up to a construct like that. So it's not fully there, but given just doing diligence takes up so many hours, you would see legal bills very ineffective billing because you're doing diligence by just reviewing things, summing it up. That's what you don't need another.
So how
resource
have you
for.
incorporated AI into your daily sort of rhythm? Like what
It's
are
a
you all
lot
using
for
today
diligence. It's
for
like for even
diligence?
for summarizing. Like
So give an
material
example,
contracts.
like what has changed and something that has really moved the needle.
So
on
material
diligence.
contracts like just take a SaaS company or even like a healthcare company, the way a lawyer would sum it up is of no relevance. As confidentiality, it will say indemnity uncapped, unilateral termination. No one cares. The actual commercial terms, what is the payout? How is the arrangement? That's in an MOU that most counsel tend to ignore. It is actually loosely worded. That's the commercial teams have struck a deal on what the payout is, and that's rarely captured adequately. And we'll say top 5 contracts, and then you don't know what the equation even is. That's helped us. That it actually summarizes in a very commercial way, makes it easier for business teams to understand, because the number of times the summaries people would send was of no relevance. What will the business team, miscellaneous contracts, clauses are largely the same. It's been very useful for that. Just identifying simple things like there's so many label or registrations. It's low-hanging fruit, but you can't ignore it. You don't have to keep pulling this out deal by deal. It's much easier to figure out findings. Though at this stage, it's what will be there in companies. It's 80% the same. Fintech companies require much higher level of diligence. So in that way, it helps. You're not doing this from ground up as a A1 associate fresh out of college doing everything. It's a lot of research that I had spent time on back then, but now you have all the information. You don't need to read 8 different things or regulations and amendments to understand what the position is. So that way it's helped.
Yeah. Avi, what do you think? Do you think fast forwarding a year or two and we keep trying to understand how the world will change? As a founder, if I am starting to get a lot of this, and I'm assuming over time, AI will also have more recent context, right? On sort of what's happening in the market. It can benchmark across, peer companies and all sorts of stuff. What's going to be the role of law firms going forward? And do you think this is actually good for founders, where they say, if AI is just giving everything to me, why do I need someone? Is that going do you see that world in coming up?
We have a company in DVC I've just met yesterday. So to her point, it makes the legal process much more efficient, given it's great for everyone. The company which is in DVC is a company that's actually a AI first distributed law firm. So I think those are all very interesting ideas. Coming to this particular context, I think let me ask you, to close a deal, how much was documentation and research and logic from our vantage point, and then emotion and judgment?
Our effort or overall effort?
Overall effort in a deal.
I just think the documentation ends up taking so much more time than it ever should. Right.
So today it would be what, 60-70%?
60-70% at all.
And then 15-15 the other two. So that 60-70 will hopefully collapse and become 30-40. And also because then a founder can know this is market.
This is
right
market,
now they
yeah.
are trusting us whether
Correct.
something is market.
Correct.
This is market. Okay, here are the trade-offs. A good founder they may even do contra of that and contra, and then just get to it. Logic, AI can still give you the logic.
Yeah.
Judgment and emotion.
And hopefully, to the earlier point, it can help you understand perspectives of the other side.
Yeah.
So you're not necessarily getting into that, argument or debate or whatever it may be.
And then the human in the loop, the good news, the way I see actually most of AI is that it makes the human become more. People think of AI wrong, and I think it applies in law firms as well. Instead of making humans less relevant, it makes humans relevant only to things they should be relevant for.
Yeah.
Right?
More effective use of time.
Yeah. So the persuasion, the emotion, the perspective, the context, that's all we should do.
Yes.
Because that's what humans are meant to be.
Yeah.
We are doing a lot of other junk work.
Yeah.
So I think that's how it will play out here also.
But
I think that's how it will play out everywhere.
But one critical thing in the US, that's why US deals get done faster. The NDCA standards, right? They have national standards and you have to follow that. Which is why there's no founder indemnity. There's a lot of protections, guardrails for both sides.
Yeah.
So it's not everything is up for discussion. I think India's tried a number of times.
Why hasn't it
happened?
worked?
Yeah,
Why hasn't it worked?
I remember telling her, she's like, one way to do it is we tell IVCA to adopt NVCA standards. I'm like, do it. She's like, but you won't agree. I said, no, we will agree. If we can, I can't agree to be the only VC firm doing it.
Right, then it's very
And then the market.
No, but if you take the top 5-7 firms and let's say 5 was, and I know we tried that. That's why I'm asking you.
No, but even within those 5-7,
there was a lot
there
of
were
disconnect.
2-3 who said we can't do it.
But was it more context specific or it was just a generic?
People had different views of what's the reason.
What should be standard?
And then you couldn't come up with it. And that's why deals are taking so long. So if we come up with those standards, then AI can track it and tell you what is market, right? Just like the way the NVCA had very helpful footnotes saying, these are the different options. This is what you could land with. Until we have that, AI can't help you because what is market? What is it going to benchmark to? You have quite a few different constructs and portfolios as one fund itself, right? Because you are co-investors. There's nuances in that. So that's why I feel like it's going to take a while. It'll be helpful to have standards so there's discipline in deals. But until that's there,
River Law will always get a lot of business till then.
Even our industry is driving forward, my favorite line, driving forward, looking in the rearview mirror. All of us have scars on our back. And everybody will say, but in that situation, this happened.
Yeah.
Is that what you're going to invest in?
All the edge case scenarios. Yeah.
These are all edge cases. Move on. Right?
Yeah. So sadly, it's that. So I think we've actually gone to the next level of nuance and detail on these. So thank you. Fantastic episode, and hope to do more of these together.
Yes.
If you like this episode of Zero to Infinity, there are so many more that you must check out. If you like Indian startup content, hearing about founder journeys, or knowing more about emerging sectors that we're investing in, Zero to Infinity is the channel that you need to subscribe to.